You ever have that feeling? You set your stop loss, you feel good about your trade, and then the market dips just low enough to take you out before ripping in the exact direction you predicted? It's maddening. Well, if that sounds familiar, you're not going crazy. We're about to look at a trading model that says that's happening for a reason.
Okay, so let's get right into it. We are going to unpack the Inner Circle Trader model, better known as ICT. And just to be clear, this isn't just another indicator or a simple strategy. It's a whole different lens for viewing the market. It suggests that price action isn't random, not at all. Instead, it's a precisely engineered environment, almost like it's being guided by an algorithm. So, to really get a grip on this model, we have to start with the fundamental question, the why. Why on earth does the market move the way it does? According to the ICT framework, it all boils down to one single, incredibly important concept. And that concept is liquidity. So what is it? Put simply, it's those giant pools of buy and sell orders that are just sitting there waiting, right above recent highs and right below recent lows. Think about it. That's where everyone's stop-loss orders are clustered. For the big institutional players, these zones are like an oasis in the desert. They need that liquidity to fill their massive orders. So when you look at a chart, just remember, these pools are, quite literally, where the money is. And this is where the whole thing clicks into place. The central idea here is that the market isn't just wandering around aimlessly. No, it is actively engineered to seek out these pools of liquidity. It's like a smart algorithm that is constantly on the hunt, hunting for the buy-side liquidity above the highs and the sell-side liquidity below the lows. This constant hunt is what drives the price. Okay, so if we know why the market moves to go after liquidity, the very next question has to be where? Is it likely to go today? And to answer that, you need a daily bias. Instead of just reacting to every little wiggle on the chart, the goal is to develop an educated guess, an opinion on which liquidity pool, the one above the current price or the one below, is the most likely target for the session. This is your compass for the day. And check this out. Here are the two main types of bias in action. On the left, we've got a reversal bias. See how the price pokes above the previous day's high, grabs that liquidity, but then immediately sells off? That's a huge clue. It tells us the real target is probably the low from the previous day. Now look to the right. That's a continuation bias. Price doesn't just poke above the high, it breaks and closes above it. That's a sign of strength, telling us the bullish momentum is still on and it's likely headed even higher. You're basically learning to read the story that the price is telling you. All right, so we've got our why, the hunt for liquidity. We've got our where, our daily directional bias. Now for the really important part, the how. How do you actually find a great entry point to get in on the move? Well, the ICT model gives you a whole toolkit of specific, repeatable patterns to look for. You can almost think of them as the footprints the market algorithm leaves behind right before it's about to make a big run for liquidity. So let's break down a few of the most important ones. First up, we have the order block, or OB. This is a big one. It's usually the very last down candle before a big move up, or the last up candle before a big drop. Now, why does that matter? Because that candle represents a spot where huge institutional orders flooded the market. Price has a funny way of wanting to come back and revisit these levels, almost to check in, before continuing on its way. Next on the list is the fair value gap, or FVG. You're looking for a specific three-candle formation where there's a gap between the wick of the first candle and the wick of the third. That space, that's the FVG. It represents an imbalance, a place where price moved so fast it was inefficient. And if there's one thing the market algorithm seems to hate, it's inefficiency. These gaps act like magnets, pulling the price back to fill them in. And finally, there's the optimal trade entry, or OTE. So after a big price swing, you don't want to just jump in anywhere on the pullback, right? The OTE uses a simple Fibonacci tool to find the sweet spot for an entry. That sweet spot is usually between the 62 and 79% retracement levels. Getting in there is considered optimal because you're getting a great price with a higher probability of the trend continuing. But here's the real secret sauce. The magic isn't in any one of these tools by itself. The magic happens when they line up. When you find a fair value gap inside an order block that also happens to be in that OTE sweet spot, well, that's what the model calls an A+ setup. It's all about stacking the probabilities in your favor. So how do we combine all these different pieces? Let's put it all together into an actual, actionable blueprint for a trade.
One of the most popular ways to apply all these concepts is through a model called the ICT silver bullet. It's a very specific, time-based strategy that's designed to catch high-probability moves during the most volatile parts of the day.
And this part is absolutely crucial. Time. This is not a strategy where you're glued to your screen all day. The silver bullet focuses on very specific 1-hour windows of opportunity during the London Open, the New York morning, and the New York afternoon. That's when things are really moving. So here's the game plan. First, you mark out your targets. Where is that key liquidity from the previous day or session? Then, you wait. You patiently wait for one of those specific time windows to open. Within that hour, you're watching for a move that creates a gap. And your ideal entry? It's when price dips back into that gap, lines up with an FVG or an order block, and gives you that classic ICT entry pattern. It's a very systematic, repeatable process. And here it is. This is the whole thing, playing out on a single chart. You see the clear target up top, that buy-side liquidity. But look what happens first. A quick dive down to hunt the stops below, engineering even more liquidity. Then, right inside that specific time window, price returns to that imbalance and offers up a textbook entry. That's the whole model in action, the liquidity hunt, the specific time, and the precise entry pattern. Beautiful. And that really brings us to the core philosophy of this whole approach. The goal is not to be trading constantly. It's about patience. It's about waiting for all the stars to align and then executing flawlessly on just one or two really high-quality setups. So, I'll leave you with a question to think about. In a world of trading that so often pushes you to do more, trade more, be busier, this model suggests the complete opposite. It suggests that patience, precision, and a relentless focus on quality over quantity might just be the secret. So, could less really be more in your trading?